All right, let's talk Civista Bancorp. Today, we're doing a deep dive into their Q4 2025 earnings call. We're going to cut through all the noise, figure out what really mattered, what's coming next, and most importantly, what it all means for the stock.
So Civista just dropped their fourth quarter numbers, and bam, the stock jumps almost 6%. You love to see it, right? But here's the thing. A big pop like that doesn't always tell the whole story. So the big question we're asking today is this for real, or is this just a one-off sugar rush?
Okay, let's get right to the headline number. We're looking at an adjusted 75 cents per share for the quarter. But, and this is a big but, how they got to that number is really where the story is.
And that 75 cents, it wasn't just good. It absolutely crushed Wall Street's expectations. We're talking a 23% beat over the 61-cent consensus. I mean, that's the kind of number that makes everyone sit up and pay attention.
And get this, it wasn't just an earnings story. They beat on the top line too. Revenue came in almost $1 million ahead of what analysts were predicting. So you've got a solid beat on both the top and bottom lines. Which of course leads to the next question. What's driving all this?
Right, so now we get to peel back the layers. We need to figure out the quality of this beat. Is this something they can keep doing, or was it just some one-time accounting magic? Let's break it all down.
Okay, and this right here, this is probably the most important slide of the whole breakdown. The official number, the GAAP number, was 61 cents. But if you pull out the 14 cents in one-time cost from an acquisition, poof, you land right back at that 75 cents we've been talking about. What this tells you is that the core business, the actual banking operation, is way stronger than that headline number lets on.
So what's powering that core strength? Well, a big piece of the puzzle is their net interest margin, or NIM. It hit 3.69%, which is up a really solid 11 basis points just from last quarter. For a bank, that's everything. I mean, widening your margins, that's the name of the game, and this is a fantastic sign.
Now remember those acquisition costs we just mentioned? They all lead back to one thing: the deal to buy Farmers Savings Bank, or FSB. And listen, this wasn't just some tiny little bolt-on deal. Management is basically telling us that this acquisition is the new engine for the whole company. It's what's going to drive their profits and growth from here on out.
So how does this engine work? Well, sure, they got about $106 million in loans, which is great, but the real treasure here, the crown jewel, is the $236 million in low-cost deposits. In today's interest rate world, that is pure gold. It's like finding a cheap source of fuel. They can take that cheap money, lend it out at higher rates, and boom, that directly juices the net interest margin we were just talking about.
Okay, so that's the story of this quarter. But as you know, the market is always looking ahead. A great quarter is nice, but what investors really care about is, can you do it again? So let's dive into what management is telling us to expect for 2026.
And they didn't just give some vague prediction. No, they laid out a super clear roadmap for us. They're guiding for another 5 to 7 basis points of NIM expansion for the whole year, and they even broke it down quarter by quarter. That's confidence. It tells you they believe they can pull off this FSB integration and manage their costs effectively.
And it's not just about margins. They're also aiming for steady loan growth. Think mid-single digits. Oh, and here's a big one. They hiked the dividend to 18 cents. That's management putting their money where their mouth is. It's a huge vote of confidence in the future cash flow of the business.
All right, so let's zoom out and put all these pieces together. What's the big picture here? What's the story they're trying to tell Wall Street? Well, it's a classic one. Normalize and re-accelerate. Here's the bottom line. Management is telling investors, hey, ignore the mess from the acquisition costs. That's just noise. The real signal here is that our core earning power is getting stronger, and this FSB deal is the key that's unlocking all of it. And they've even given us a calendar of events to watch. The deal's done. The big tech systems get merged in early February, and that means Q2 of 2026 is the big one. That's going to be our first truly clean look at what this new combined company can really do. That earnings report is going to be a huge deal.
All right, so there's the setup. We've torn apart the quarter. We see the road ahead. Now for our part. What's our take? What do we think this means for the stock and the next earnings call?
So, this is the million-dollar question, isn't it? After that nearly 6% jump, is the good news already baked in? Does the market really get the story yet? Have they fully priced in this shift from a messy quarter to what could be a clean, powerful earnings machine? Well, our answer to that is no. We don't think this story is fully priced in at all. That's why we're slapping an outperform rating on this one. And here's why in a nutshell. First, you've got a super clear catalyst coming up with the FSB integration. Second, that guidance they gave on margins, we think it's pretty achievable, maybe even a little conservative. That sets them up perfectly to beat expectations and raise guidance later. And finally, as the story changes from messy to clean, we think there's plenty of room for the stock's valuation to go up.
So how would you play this? Well, we call this the wild but plausible trade. The whole idea is that a clean beat and raise in Q2, that first full quarter post-integration, is going to force Wall Street to re-rate the stock higher. The action? You'd want to be long the stock heading into that report. You're basically making a bet that they nailed this integration and prove that this new higher earnings power is for real.
And that's our take on Civista Bancorp. A really interesting story playing out here. Just a quick reminder, as always, this is just our analysis for informational purposes. It is absolutely not financial advice.